Hello traders, Gary Wagner here, approximately 1 o'clock in Honolulu, 7 o'clock in New York on Friday. Happy Aloha Friday, as we say on the islands. It's June 25th, 2021, and this is the daily report for gold and silver, our weekend review. And what a week we have seen. After 3 weeks of consecutive declines, major declines in gold, taking it from 1920 down to the 1700s, mid-1700s. We have definitely seen an uptick. Gold closed up approximately $17 on the week. And there is a technical case to be made that we are consolidating in this area in both gold and silver, and we could see prices move higher based upon recent data coming out from the government showing an uptick in inflation. We'll talk about that in our opening letter. We'll address that when we pull up our charts during the show, which begins now. Gold has been dropping in price for the last 3 consecutive weeks. That changed this week, with gold eking out about a $17 rise, about a % gain on the week, and a $5.10 gain on the day. 1781.80 is our closing price for Friday as we go into this weekend. And we've seen signs that there is a real attempt for gold to find support at this current area, with a caveat. We'll talk about all of that when we pull up a chart. The majority of this week's rise in prices for gold does not really have to do with the dollar so much, because the dollar in essence has been flat all week. As you can see on this daily chart right here, the dollar did close lower, but fractionally lower, currently trading at 91.77. This first chart that we are looking at is a weekly gold chart, and we can definitely see the price demise over the last 3 weeks, which took gold from a high of above 1920 to these lows at around 1760, a tremendous drop in price when you consider that just about a month ago we had $1,900 gold. Now we have close to $1,800, with the market closing at 1781. The key right now, I believe, is this trend line. On a weekly chart, we have simply defined 2 lows, this low here as well as this low here. You can see the gold basically opened just below this trend line, but effectively closed above it. But where we can see the true movement of gold, because there hasn't really been much this week, it's been more gold forming a base, we really need to look at our daily charts. We are looking at a daily chart of gold, of course, in candlestick format. What is clear and evident when we take a look at recent price activity from Monday, which is this large green candle here, in which we did see a sizable rise, the rest of the week followed with small differences between the open and closing price. That's why you have relatively small bodies. They're almost dojis, in effect, which could be signaling a period of consolidation or can indicate a potential pivot. Now, in the case of gold, we have to look at the Fibonacci retracement, in particular the long data set that we are using, which begins from the lows of March 2020 up to the highs achieved in August 2020 at 2,088. And we can see that the market, as it sold off, formed a double bottom just below the 61.8% retracement level, and then moved much higher, trading until it hit resistance just below the 23.6 fib level at 1942. And what we can see on this particular move here down is that on this large data set, it actually comes to a 50% retracement. So a pivot would look something like a V formation, where the market went down, it consolidated, and then moved higher. So traders, what I have done is simply modify or create a new fib retracement data set. In the case of this data set, we're starting from the lows of this March at 1668, in fact, the double bottom, up to the top at about 1920. What is fascinating is if we look at current pricing, because what we're seeing is that based on this rally, taking gold from 1668 to 1920, it fell and found some tentative support at the 61.8% retracement level. At 1765. So to a large degree, we do have a harmonics between the larger data set indicating a 50% retracement and this shorter data set accounting only for this last rally going to the 61.8% Fibonacci retracement level. Also, the fact that we've got a series of dojis, we have a consolidating market or a base forming, and that's all extremely bullish for gold. There is a caveat, and we spoke about that at the beginning. The caveat is something that we might not need to really bother with because it's very, very long-term indicators, and I'm speaking about the moving averages. Take a look at this. The red line represents the 200-day moving average on top. The green line represents the 50-day moving average. You can see the 50-day has definitely been moving closer and closer. It breaks through the 100-day here. And, of course, market bulls were hoping that we would see it break through the 200-day, thereby beginning to put this into normal alliance. Of course, the 100 would have to cross above the 200. However, as we see this market right now, it is getting very, very close to what is called a death cross. A death cross in its truest sense is when the 200-day crosses below the 50-day moving average. Now, these are highly lagging indicators, and that's what I have to underscore. The fact that we found a base at this price point, and we can define this price point not only by areas of support, such as the price range in April through March of this year. You can see that right here, and that was a defined support level. For a small part in the third week of February, we saw that, of course, it fell lower. That was where we created this double bottom here. But for the most part, to me, these are signs of a market that has fallen. It has a 61.8% retracement. That is a good, strong retracement. It has formed a base through the week. It has gained about 1% in value, or about $17, and now could easily pivot from these declining prices to begin to move higher once again. If that happened, you would see these lines, the 50-day and the 200-day, begin to widen between each other. And so, because it's a lagging indicator, it's not the first indicator we need to look at. We need to look at support levels, resistance levels, based on retracements. And that's exactly what we're doing. We also have to take a strong look at activity this week. We've had a series of doji-like candles, and that's indicating price consolidation or a pivot. In either way, it gets me to a point where I believe that it is likely that we could see a spike higher in gold in the upcoming weeks. Silver also seems to be forcing a base, as witnessed by the last couple of days of trading, in which it has effectively stayed above the 200-day moving average, and today it gained 14 cents, back over $26 at $26.19. When we look at a daily chart of silver, what we see is very, very much a similar type of formation to what we saw in gold. And that is, this week really had a number of small-bodied candles. They were much less doji-like than what we saw in gold. However, we did see silver maintain a price point above its 200-day moving average, and it is in still proper bullish alignment, which is the 200-day below the 100-day, which is below the 50-day. And that's perfect alignment. It also matches up with a 23% Fibonacci retracement level at about 25.75 as a support level. In terms of resistance, I peg it at about 26.70, and that is based upon the 100-day moving average. However, copper, which has been attempting to stage a rally, you can see this V formation here as the market traded lower, a defined correction, breaking below the 100-day moving average. That did close lower on the day. It was at about 431 yesterday. It is at 428 if we round that up in trading today, losing about 0.8%. Lastly, I want to take a look at a daily copper chart. There's no doubt copper has been on an absolute tear. Considering a move from just about $2, this is back to the lows seen in March 2020, up to this all-time record high for copper pricing at over $4.80 a pound. It has retraced approximately 23%. That's a valid Fibonacci retracement level. We do have a V that came in taking it above that price point. It is trading above the 100-day moving average. That is bullish. Obviously, resistance is at $4.48. That is the 50-day moving average. The question is whether or not China is done with their artificially taking copper prices lower by releasing massive amounts from their state stockpile. We can see that the last 2 days the market is consolidated, and that is occurring just after 3 solid gains that we saw posted. These gains took copper from about $4.07 up to about $4.35 per pound. We will remain flat with no active trades in gold, silver, or copper. We're seriously looking at the potential for a pivot in gold and silver. We're looking to see what copper does. All of that will occur next week, and realize that we're going to go into the 4th of July weekend, which means that Monday the 5th, the markets will be closed. So we'll have a full trading week next week, followed by a shortened trading week for the first week of July. This has been Gary Wagner, wishing you as always good trading. Have a great weekend. We'll talk to you on Monday for the next daily update and review. Bye-bye.